Hello and welcome to this session in which we will discuss expatriates and corporate inversion. What is the big idea of expatriates and corporate inversion? It's when an individual or a corporation, when we use the term expatriates, we are referring to a person, to an individual that decided to leave the United States, decided to live overseas, and discontinue all their tax relationship or taxing relationship with the US government. Simply put, they would say, I would like to renounce my citizenship. Why? Because if you are a citizen, you have to pay your taxes regardless of where you are. Either if you're in the United States, if you are in Europe, if you're in Asia, if you are a US citizen or a green card holder, you're under the US jurisdiction. Therefore, what you have to do, if you don't want to be associated with the US tax system, you have to renounce your citizenship. And this is what expatriates mean. You just want nothing to do with the United States because you don't want to be taxed as a US individual, US person taxpayer. Corporate inversion, similar concept, but the corporation basically go through a corporate inversion. Therefore, they're not subject to US taxation. And this is what we will discuss in this session, starting with the expatriates. What are the rules that applies to individuals? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
We have something called mark-to-market tax. Mark-to-market tax is what? Mark-to-market tax is when an individual decides to leave the US, expatriate, denounce their citizenship. They want nothing to do with the US taxing system. They don't want to be considered a US citizen. What we have to do is this. We means the US government, the IRS. They would say, okay, now you're leaving. You might be subject to something called mark-to-market tax regime. Now, not everyone that renounces their citizenship is qualified to be under this tax regime or those tax rules, but we have to know who. So to fall under this category, an individual must meet one of the following criteria. They must be even high earners. They make substantial amount of money. They have substantial wealth. Even if they're not making income, they have wealth. Or they have a history of non-compliance with tax laws. Why do we do this? What's the idea? What's the logic behind this? Think about when someone passes away. When someone passes away, we still apply to them the estate tax. So if you built your wealth in the United States, if you created your wealth in the United States, what we're saying is, even if you die, let's assume you die tomorrow, you might be subject to an estate tax. Well, if you're leaving, if you're denouncing your citizenship, well, the same concept should apply. You have to pay some sort of a tax. What individuals are considered covered expatriates? This is what we'll discuss next, specific rules. One, there's a tax liability test. They would look at your tax history. And if the average annual net income tax owed to the US government over the past 5 years prior to your renunciation, so they would look 5 years prior to said, I'm deciding to leave, exceeds a certain limit. Now this number is subject to inflation, so it changes every year. So if it's 190,000 for the year 2023, but they would look at the past 5 years, then you will meet this criteria. If you owe the government 190,000, you are making a substantial amount of money. Therefore, you are considered a high earner. As a high earner, you are subject to what? To the tax, to this mark-to-market tax. Or they would look at your net worth. What is your net worth? Look at your financial standing at the time of you are leaving. If your net worth is 2 million or more, again, this number will change. You satisfy this test. Therefore, you are subject to mark-to-market tax. Or there's something called the test checks, the individual's tax compliance history. Let's assume you have not been filing your taxes in the past few years, and now you decided to leave. Well, that's not easy. You have to pay your taxes first. If the person failed to fulfill their U.S. federal tax obligation in any of the 5 years leading up to their expatriation, they would meet this condition and they will be subject to this mark-to-market test. Now, how is that tax computed? Well, if the individual is a covered expatriate, it meets the prior 3 rules that we just discussed. Well, the assumption is this. We assume that their assets are sold one day before they renounce their citizenship. So one day before you renounce your citizenship, we say you sold all your assets. The income generated from the sale is obviously hypothetical. So we assume that you sold all your asset. Then here's what's going to happen. We're going to give you a deduction. Deduction is, every year it changes, happens to be $821,000 for the year 2023. It means that gain up to this amount from the deemed sales is not subject to tax. So you can get up to this much in gain and walk away. You don't have to pay taxes. Also, the individual, the expatriate, they have the option under Section 877A, Section B, to postpone payment on the taxes that arise from the deemed sale of their asset. What does that mean? It means you sold your asset, you have a gain. Let's assume the gain is $5 million. Then you can deduct $821,000 of it. What's left is subject to tax. Now, you don't have to pay the tax on this amount. You can postpone the tax until later date when you actually sell it. Now, if you want to pay the tax and get done, you can do that. But the individual can choose to pay the tax at a later date instead of immediately in the year of the deemed sales. Let's take a look at an example. Let's assume David, a U.S. citizen who has spent several years living abroad. He is the sole owner of a company called Tax Solution LLC. It's a US-based company. His ownership interest is valued at $3.5 million. His basis in the company is $500,000. In 2023, David decided to renounce his citizenship. Say, you know what? I want nothing to do with the US taxation system. I want to give up my citizenship. This way, I'm not subject to US taxation. And he decided to settle in Singapore. Well, we're going to assume that the exclusion is $821,000. Well, David will be considered a covered expatriate because the value of his company is 3.5, which is above 2. So he does meet one of the criteria. So according to the mark-to-market regime, guess what? He sold his interest. What's his interest? 3.5 million. He has 5 million in basis. So he has 3 million in what? In gains. 3 million in gains. Now, so 3.5 million fair market value minus the basis. Then the government says, we're going to exclude from your gain 821,000. David still subject to 2,179,000 of capital gain. And we're assuming this is long-term capital gain. He had this company for several years, those stocks, therefore it's taxed at a long-term capital gain rate. Now, when would David pay? He can pay now or he can pay later. Now let's talk about corporate inversion. Similar concept in a sense that rather than an individual, a corporation, they decide not to be a U.S. corporation. They just say, you know what? I don't want to be considered a U.S. corporation. I don't want to be subject to U.S. taxation rules. So when a U.S. company restructure to place itself under a foreign company, for what purpose? To lessen or to remove the U.S. tax burden. They decided to, you know what, it's not in our best interest to have this company under the U.S. tax burden. So this is what corporate inversion is. Okay, and the resulting entity is termed as expatriated entity. So it's not an individual, it's an entity. Well, the tax treatment of this entity depending on what the ownership structure post-inversion. So we would look at who owns the company after they inverted. If the original owner, if the original U.S. shareholders retain a significant stake in the foreign parent company, specifically 80% or more, so if this company, 80% or more of their shareholders are U.S. shareholders, this is a U.S. company. It doesn't matter what you do, it's still subject to U.S. corporate taxes. So guess what? If you want to, you have to reduce this. How about if we reduce them 60 to 80%? If the original U.S. shareholders hold between 60 and less than 80 of the interest of the foreign entity, the entity is now restricted to utilizing certain tax benefit, like net operating loss and foreign tax credit. To do what? To offset any inversion gains, because you cannot use those NOL and foreign tax credit to offset inversion gains to reduce your taxable income. That's basically what you need to know. Now, bear in mind, the U.S. government tries not to encourage companies to leave. So the Tax Cuts and Jobs Act discourage inversion. How? Well, here's what's going to happen. If you did invert, any dividend from the surrogate foreign corporation, means the one that left, U.S. corporation that received dividend from these expatriated entities, surrogate foreign corporation, are ineligible. You're not eligible for the 100% dividend received deduction, which is available for inter-corporate dividend, which is the dividend coming from a foreign entity. Also, individual shareholder who receive the dividend from those surrogate foreign corporation, usually when you receive dividend, it's qualified capital gain. Guess what? If it's a surrogate foreign company, guess what? We're going to tax this dividend at the higher ordinary rate. Remember, the highest rate for capital gain or qualified dividend is 20%. An individual rate could be up to 35%. So therefore, we'll tax you at the higher rate. Again, what are we trying to do here? The U.S. government is trying to mitigate, reduce, give discouragement for companies to do what? To do an inversion. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following statement best describe the tax implication for a covered expatriate under the mark-to-market regime? Which one is best described? Which is true? The covered expatriate must pay immediate tax on a total value of their worldwide asset. First of all, they don't have to pay their tax immediately if there's any tax, and it's not about their worldwide asset. So that's incorrect. It's about the gains if your assets are sold, but not your worldwide asset. The covered expatriate is taxed on the deemed sales of assets with no possibility of deferral. Yes, there is a possibility of deferral, therefore this answer is incorrect. What does that mean? It means you will count your gain and you don't have to pay the tax until you actually sell it. You can pay if you want to on the deemed sales, assumed sales, but you don't have to. So there is a deferral option, therefore B is out. C, the covered expatriate can elect to defer the tax payment on the deemed sale of the asset until actual disposal. Yes, and this is exactly what I said. You can defer the tax payment on the deemed sale, the assumed sale, until you actually sell it, because you don't have the money until you sell it. The covered expatriate receive a tax credit for all taxes paid to foreign countries on deemed sales? No, we're not going to give you any credit anymore. If you don't want to be a U.S. citizen, no credit for you. Therefore, the answer is C as in Charlie. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you with your CPA exam or your accounting courses, professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.